Pay your mortgage faster and save thousands. Hey, I'm Sebastien. I became debt-free at 37 and semi-retired at 46. Welcome back to the channel. Today, I want to share one of the most powerful financial strategies available to homeowners. It doesn't require earning more money, it simply requires understanding how mortgage works. If you can reduce the amount of interest you pay over the life of your loan, you can potentially save tens of thousands of dollars and even pay off your home years earlier, and a lot easier than it sounds. That is exactly the kind of snowball effect I love talking about on this channel. The first thing I recommend is downloading or creating a loan amortization spreadsheet. There are many free Excel templates available online. Once you have one, enter the following information: your mortgage start date, the length of your loan, whether it's 15, 20, or 30 years, your down payment, your interest rate, the total amount of your mortgage. Then when everything is entered correctly, the spreadsheet should calculate your monthly payment, showing almost exactly how much goes toward principal and how much goes toward interest every month and what you're paying on a monthly basis. Hopefully, when you purchase your home, you chose a fixed rate mortgage instead of a variable rate mortgage. A fixed rate provides stability. A variable rate can become very expensive during periods of rising interest rates, recession, or market downturns. Predictability is one of the greatest financial advantages you can have. Now, let's talk about early mortgage payment. Whenever you make an additional payment, make absolutely sure your lender applies that extra money directly toward the principal, not toward future monthly payment. Reducing your principal today means paying less interest tomorrow. Here is an example. Using approximately the national average in 2026, a $380,000 mortgage over 30 years at an interest rate of 6.5% results in a monthly principal and interest payment of roughly $2,100. It is something many people don't realize. During the first year of your mortgage, most of your monthly payment goes toward interest, while only a small portion reduces your principal. As the years go by, that gradually reverses. Less money goes toward interest and more goes toward building your equity. That's why making additional principal payment early in your mortgage has such a powerful financial impact. Let's demonstrate by using directly a loan amortization plan file. Let's go. Okay, my apologies, but on this video, the second part may not look as clean as other ones, simply because I'm using a computer that is not connected on internet. That's where I do all my finances, so there is no issue of breach or access to personal and sensitive data. So anyway, you will see this is a loan amortization plan. This is all you need to fill out. So I put the date of July 1st, 2026 for a loan amount of $380,000. This is again national average, 6.5% interest rate, 30 years, 12 months per year, and it automatically computes the scheduled payment of approximately $2,400. I said $2,100, but my apologies, and correct that. It also compute the total interest you're going to compound over the 30 years. So to have a loan of $380,000, you will pay over the 30 years an additional almost $500,000, $485,000. This is excruciating. So let's say month number 13 right here. Let's say you can do just like an additional payment on an extra payment just on the principal, let's say of 2,000. And then once I press enter, I want you to see two things. Actual number of payment 355. You saved 5 months. Remember, we said that the total interest you will pay over those 30 years is almost 485,000. Now it's down to 474. So whether you believe it or not, and you can ask and do simulations with your loan mortgage officer, it will give you the same information. This is a saving of $11,000 and 5 months by just putting a down payment of $2,000 after 1 year. And this is how powerful it is. This is what I want you to know. Let's say you will do an additional payment of $5,000. Let's say you get tax returns. Don't waste it. Put that here. Now you saved 13 months. It's over a year out of 30. And as far as interest, from 485 to 458, you literally save $27,000 of interest. So it should make you think. And you can do smaller payment. Let's say I do $100 here. And it would be too long for 30 years. But if I was computing and going every year and putting $100, which is absolutely nothing, just twice after the first year and after the second year, just $200. You did not save anything in time, but you saved about $1,200 overall. So it is not bad. So I really want you to understand that the power of doing extra payment on your principal and the impact financially on your interest, but also as far as time. If, let's do another example, if I do 2,000 every year, and I just do that for the first 3 years, right? So we did 2, 2, and 2. After year 1, 2, and 3, $6,000. You reduced by about $29,000 your interest, and you saved over a year, 14 months. So I could do many simulations. If I don't want that video to be overwhelming, I want you guys to understand the concept of it. Get online, find those loan amortization or those loan amortization plan or loan calculator. Play with it. And this is exactly what it will happen on your bank account. Principal. Just want to show you at the very beginning, month 1, that $2,400 monthly payment, 343 are going on the principal, almost 2,100 of interest. This is all the interest you're paying up front, and it will keep getting lower and lower while your principal will increase. You see, the last month you'll pay only $3.62 of interest. Or let's do its partial payment, but look at the one before, $16 compared to $2,385. So the ratio is completely different. So just keep that in mind. Play with it. Powerful tool. Do that. I've done that on 2 properties, and definitely it will change your life. You can save tens of thousands, even hundreds of thousands of dollars. Again, we demonstrated earlier just with a $5,000 extra payment on a principal on year 1, and you save almost $27,000 and over a year of mortgage. So when I'm talking about thousands or tens of thousands of dollars, just one extra payment after year 1 will save you $27,000. So I let you imagine if you can do that every year for the first 4 or 5 years. It's ridiculously interesting. Hope you liked that video, and I will see you in the next one. It was Seb.